Hi there, good afternoon. You're tuned into ET now, and this is Market Fatafat with me, Cheryl D'Souza. Along with me, have Vinny Modiwala. Very good afternoon to you, Vinny. And the markets are doing exactly what they were doing in the morning. We are trading with a negative bias, 0.3% downtick coming in for the benchmark indices. We've slipped below the 18,100 level, which we are trying to regain slowly and steadily in today's trading session. If you look at Nifty Bank, that one is trading in tandem with the benchmark indices. It's the PSU Bank index that's actually losing the most in today's trading session. This on back of what is happening to some of the lenders to go first. So the likes of Bank of Baroda, Central Bank, IDBI Bank, even Axis Bank, all of them are under pressure on back of that particular on back of that particular news flow. A lot of stocks that have come out with their earnings today. So you have MRF that came out with its earnings. So let's take a look at what that particular counter is doing in trade today. Apart from MRF, you had Godrej Properties also that came out with its earnings some time ago. And also you have Rane Brakes also that came out with their earnings. But not just that, Vinny, we also had Adani Wilmar that actually came out with its earnings earlier in trade today.
Absolutely, just came out with its earning an hour back, and what we're seeing in terms of the revenue growth and all, we're seeing that coming in from the company as well. Let's keep an eye on that. And as of now, we are joined by the management to talk more about the numbers. And Mr. Malik, the CEO and MD at Adani Wilmar, is joining in with us, as well as Mr. Kannare, the CFO at Adani Wilmar, is joining in with us. Very good afternoon, gentlemen. And I just want to start, Mr. Malik, with terms of the commodity prices. When you look at the commodity prices, palm oil prices, month-on-month basis, year-on-year basis, now we're seeing a decline coming in. The company had taken price cuts before as well. Now, what we're understanding is reports are suggesting that we'll be seeing more of a price cut coming in. Could you give us an understanding in terms of, what is the on-ground situation currently? Is the company looking at taking any price cuts? And then what are the margins looking then?
You are right that the commodity prices have come off from the top, and as any other branded edible oil player, we have been watching the commodity prices, and accordingly our MRP has also been reduced. To begin with, say in January, soybean, our Fortune soybean oil 1 litre pouch was 170 rupees MRP in Delhi, which is today 140. So you can know that over the period from January to May, we have reduced it gradually, basis how the overall commodity prices are.
Right. Good afternoon, Mr. Malik, as well as Kannare. There is Cheryl also joining in the conversation. Let's talk about the inventory cost. We know that the high inventory cost also impacted your margins in the quarter gone by. If you could tell us how much of that still continues to persist, and also will it impact your Q4FY23 as well?
Yeah, I'll take that question. In fact, as far as the inventory cost is concerned, I think one of the major element in inventory cost is, of course, the interest cost. And I think we all know the rate hiking which has been going on for last more than a year. Actually, that impacted our overall performance in terms of bottom line. That still continues. Today also, we are sitting on an interest rate which are quite high. There is no possibility or no nothing like interest rate cuts which we are expecting. So those will continue. But however, as we move forward, I think since the edible oil prices have come up and have been stabilized, the demand is coming up, I think we should be able to, pass on this interest rate and other inventory costs to the consumer.
Okay, you'll be able to pass on that to the consumer. But also, I just want to understand in terms of just rural market, that is an important factor that comes in for most of the companies as well. How is that shaping up for the company? What are we seeing in terms of the rural market trends? Because obviously we are seeing unseasonal rains coming in, could see an impact on the crop. So all that could in turn somehow impact us as well, because we do have the FMCG business as well. So what is that indication we're getting there right now?
On this, I had said that the first 2 quarters of this year of FY23, the rural markets was definitely not supportive. Things started opening up from Q3 when we saw after the harvest, the rural economy started going up. But in January, I had said that the rural market now looks much better than Q3. So Q4 was looking better. Just to give you an idea about how the edible oil and branded staples food business has done urban versus rural. If I go Q1, the rural share in edible oil was 30%. For us, when we take rural at Adani Wilmar, we consider any town less than 1 lakh population is all rural. and anything above that is urban. So 30% would come from rural. Then Q2 was 29%. After that, Q3 was 29%, but in Q4, we got 31% share. So that means in Q4, there was surely an up movement about the rural. The same if you see in foods, very interesting. 29% share came from rural, then 30% Q2, 30% Q3, and 34% Q4. That means in Q4, both staples food, that is packed rice, wheat flour, sugar, pulses, dal, oil, all these products have shown surely a better result in Q4. So that should indicate that rural possibly is opening up. One of the reasons I see is that edible oil prices have come down, the consumption has gone up. So rural has started consuming at least the edible oil, branded staples better.
Hopefully things will look brighter going ahead, Mr. Malik. But then let's talk about your food and your FMCG business. Segmentally, if you look at the performance in the quarter gone by, there's been a sharp improvement. Also, over the course of 1 year, we've been seeing improvement in that particular segment. So going ahead, where do you see this one headed from here on? How much of a contribution do you see for this particular segment to have on your overall revenue?
See, we have been focusing on food since last 2-3 years surely, and we have been ramping up our processing capacities. We are bringing in new assets. So today, if you see the food volume is roughly around 17%, Shrikant, 17% of the total. This was lower last year at around 13%. Going forward, if we continue to grow at around 40-45%, that's what we have been doing, because we have doubled the turnover of food in 2 years. If we can continue this type of pressure, which we see there is a possibility, because honestly, the branded food segment is much smaller than oil. Oil is at 70-75% branded, but if you take atta, which is the largest staple food, is 12% branded, rice is 5-8%, pulses is 5%, sugar is 5-7%. So there is great room to grow in the branded commodities, and we are surely concentrating on that because we see there is great opportunity.
Okay, thank you so much, gentlemen, for joining in with us this afternoon on our Market Fatafat, giving us an understanding on the numbers, and obviously FMCG is going to be a focus for them as well. But let's move on from one earnings to another. Now, TV Narendran, CEO and MD at Tata Steel, spoke to my colleague Ajay Sharma on the latest update on the European business and the road ahead as well. Let's go cross and listen in.
Yes, Europe continues to be a challenge. Things are getting better, slightly better, but we expect another challenging quarter and then things to get better from Q2. Few things. One is our strongest business in Europe is our Dutch business, and Dutch business is traditionally cash positive, EBITDA positive, but they've been challenged because of the rising gas and electricity prices last year, and the need to build up some slab stock because they were shutting down their blast furnace in April. So I think because of these events, the Dutch business had a tough few quarters, but the blast furnace is going to come back on in August, and after that we expect things to go back to normal. So that's the guidance on the Dutch business. Otherwise, in Europe, at a very fundamental level, the gas prices and energy prices, electricity prices have all come down. They're coming back to where it used to be before the war, still higher than what it was before the war, but coming down very significantly to where it was in Q2 and Q3. UK is where we have a slightly more longer term challenge. While the UK business will get better in Q1, it will still be EBITDA negative. But in UK, the other challenge is many of the assets are going to come to end of life in the next year or two, and the business is not generating the cash flows to support any significant investment or transition. That's why we are talking to the government, and depending on how the conversation goes with the government, we'll have to see what is the future of those assets.
So the street is really wanting to know that some visibility on how are things looking from here on demand side, especially in Europe. One sense is that the worst of demand could perhaps be behind us, and demand trends may gradually, however gradually it might be, start improving. One set also believe that Q1 perhaps could be where European side of things may actually bottom out for sure. Plus, of course, what is happening on the macro front on operating costs, etc. If you could share some angle on that.
So there are a few things to be kept in mind. One is Europe is also very closely linked to what happens in China, because a number of European countries export a lot to China. So if you look at the sentiment in Germany became positive when China opened up after COVID, right? So things like that, because a lot of capital equipment goes from Europe to China. So if China does well, or China does better than it did last year, that will have a positive impact on Europe. Second thing is when energy prices come down, that's positive for Europe, because a lot of industries were struggling with high energy costs. And energy prices settling down, gas prices settling down, electricity prices settling down is a positive for Europe. The overhang of the war is still there. If something happens there in terms of some sort of rebuilding or reconstruction starts in Ukraine, that's very positive for Europe. Inflation is still a concern. So that is a deterrent. So, but I would think the worst is behind us as far as Europe is concerned. There's also a lot of investment going to happen there to transition the economy to a greener future. So that will also lead to a positive impact on economic activity. So I think certainly if you look at it from a steel consumption point of view, we are expecting consumption to come back to positive levels from next year for sure.
Let's turn focus on the India business, Mr. Narendran, because that was exceptionally strong. Realization, volume, both actually picked up pretty smartly. How are things shaping up over there? Do you think this momentum can sustain?
Yeah, India, I think the fundamentals of demand are still very strong because of construction activity. Auto industries got revived. Passenger cars are back to where it was pre-COVID. Commercial vehicles, which is a lead indicator, still very strong. If you look at pre-engineered buildings, industrial buildings, order book is strong. So in multiple areas, we see things are strong. The rural economy is what was a bit more fragile. Consumption at the lower ends of the community was what was a bit fragile, which was reflected, let's say, in motorcycle sales, which is largely sold in rural India. We are seeing that picking up quarter on quarter. If you have a decent monsoon, we expect that to be a positive also. So overall, we are strong on the fundamentals of demand in India, and with the kind of money the government is spending on infrastructure, I think it's very positive. I think the concern is obviously a little bit of what's happening around the world. Industries and companies who are dependent on export markets are a bit more circumspect. That also brings down the sentiment a bit. We cannot be immune to what's happening around the world, and I think that's the only concern. From a Tata Steel point of view, we're getting the benefit of the Neelachal volumes. We are now running full out. So next year will be a year when the full Neelachal volume will come to us. We are already running at a 1 million rate. Kalinganagar expansion is going on. We've started the pellet plant, which will help bring down costs for us in Kalinganagar. In the next 12 to 18 months, we will be commissioning most of the facilities in Kalinganagar, and we'll get the 5 million tons additional volume also going forward. So we are very positive about our prospects in India.
A bit on the pricing front, prices of steel price. Last time we interacted, you had indicated that your expectation was that probably 60 to 65,000 per ton, it could edge towards, we've crossed 60,000. Do you see some more upside? And also, how is China factor playing a part in this?
So I think if you saw it cross 60, it was around 61, 62, then it's come down again, reflecting more the international sentiment. I think there are two big factors which will drive sentiment, or three factors. One is the domestic demand in India, which is positive. Secondly, China's recovery and resurgence, if any, this year. So far, the forecast is China will grow at 5.5%, which is good. So if China stays strong, that's good for the sentiment. Third is coal prices. Of course, coal prices are also linked to what's happening in China. But coal prices have come down very significantly in the last few weeks. And then there is an anticipation that steel companies have more margins and hence may have more room to drop prices. But what has happened is coal prices went down, Chinese steel companies dropped prices, but today Chinese steel companies are back to very, very low margin levels. So I don't expect this situation to continue for very long, and you should see a little bit of pushback and on steel prices. And I think this week China is on holiday, and that's why the sentiment is still looking for direction.
Mr. Narendran, one key monitorable has been your debt reduction process. This year, you couldn't really meet the target which you had, but you have not kept your overall target unchanged. So where do we stand on the debt reduction of $1 billion per year kind of debt reduction which you spoken about earlier?
Yeah, I think we stick to that. We didn't hit it last year because of more money going into working capital, plus the fact that we acquired Nilachal for 12,000 crores, plus the fact that we also acquired a few smaller assets on the ferroalloy side. So because of all that, the net debt increased during the year, but we are going back to our target of reducing by at least $1 billion. Ever since we announced it, apart from last year and all other years, we've exceeded it. So we expect that next year we will be back on track for that $1 billion.
Okay, that's the word coming in from the MD and CEO at Tata Steel. But let's move on, and we have Ashish Mohta, the Senior Managing Director at Blackstone, joining in with us. And obviously, this is why, because Nexus REIT will be coming out with its IPO on the 9th of May. To get more details about the IPO, let's go across to Ashish. Thank you so much, Ashish, for joining in with us this afternoon. Let's just start by talking about the IPO, your key features. What is it that is keeping you apart from everyone else then?
Yeah, sure. So, Nexus Select Trust is, India's largest retail platform, spanning 17 malls, 14 high consumption cities. We've aggregated this portfolio since 2016. Nexus manages this, under the leadership of Dilip Sehgal, who's a veteran in the industry. Under the IPO, we're looking to raise 3,200 crores, basically as a mix of primary and secondary, at a distribution yield of 8.25%, and a 3-year average of about 9%. So that's basically on the IPO.
Good afternoon, Mr. Mohta. This is Cheryl also joining in the conversation. The Blackstone Group is actually the sponsor for Nexus Select Trust. If you could tell us how much are they planning to dilute their equity holding via this IPO?
So we're close to about 60% pre-IPO. We will, still continue to hold 43% post-listing. So we continue to believe in the long-term growth potential of the sector, of the malls, in India, of the growing consumption that we've seen across the country, which is why we are long-term holders of this stock.
Could you also just talk to us and tell us about your assets that are there in your portfolio in terms of your area and the breakup of the malls and office spaces?
Yeah, so this is, about 10 million square feet of retail area, 9.8 million square feet to be exact, across the 17 malls. In addition, we also have 1.3 million square feet of offices and 2 hotels comprising 354 keys. But just to give you a sense, these offices and hotels are essentially complementary to the malls, so they are essentially part of large mixed-use developments, and all asset classes in some sense feed off each other. So, but that's the broad breakup of area, across these asset classes. 90%, however, of our value, of Nexus continues to be retail, and that will continue to be the dominant asset class that we will focus on.
Right. Let me ask you the most pertinent question then. How much are you planning to raise via this IPO? Also, if you could tell us how are you planning to use the proceeds that you raise via the IPO?
So we will raise, close to about 3,200 crores as a mix of primary and secondary. The primary raise is largely to pay off existing shareholder loans, and the secondary is an offer for sale from some of our Blackstone funds and one of our partners in Pune. The reason why we are doing an offer for sale right now is our leverage continues to be pretty low. We will post IPO continue to be only 15% levered in the company, so there is no need to sort of pay down further leverage, and the company continues to have strong cash reserves going forward. So what we wanted to achieve was do a sizable IPO so that there is good aftermarket trading on the stock.
And lastly, if you could just tell us what is Nexus Select Trust expansion plan post IPO? Where could we be seeing the company grow further?
If you look at our current portfolio, Anurag, what we have is 17 malls, 14 cities, But more importantly, these 14 cities comprise almost 30% of India's consumption. So we have large, almost all of the tier 1 cities, but also some of the large consumption centers like Bhubaneswar, Indore, Mangalore as part of our portfolio. What we really want to try and do is replicate this going forward. Try and acquire more assets in tier 1 markets, but also high consumption markets, across India. So think about state capitals, Lucknow, Guwahati, Calcutta, where we don't have a presence today. I think are natural places where we will look to sort of grow this.
All right, Mr. Mohta, we leave it at then. All the best for the IPO, for the upcoming IPO of Nexus Select Trust. And on that note, we'll actually slip into a break on this edition of Market Fatafat. When we come back, we'll get you all the buzzing stocks and trades, so don't go anywhere.